Hi, everybody. My name is Stephen Rothstein from Ceres. Thank you for joining us today. We're going to give people just a minute to join as they're logging on. So just thank you for joining. Just stay with us and we'll get started in just a minute. Again, if you're just joining, thank you for joining. My name is Stephen Rothstein from Ceres, and we'll get started in just less than a minute, but appreciate your time today. Great. Well, I want to welcome all of you for joining. My name is Stephen Rothstein. I'm the Managing Director of the Ceres Accelerator for Sustainable Capital Markets. And we have a distinguished panel, which I'll introduce in just a minute. But first, to thank you for your time and again, to make sure you know that this is being recorded. And we very much want to engage with all of you and ask your questions. So please submit questions in the Q&A throughout this. And we hope to get to as many of them as possible. Those we don't get to during this, we'll follow up, assuming we have your contact, follow up with you. And then we'll be sending this recording to all of you. This report, unfortunately, when we were thinking about this report probably 9 months ago and used this graphic from Storm Sandy from several years ago, we had no idea that just a few days before this report would come out, the New York subways would be flooded again. The physical crisis that we're facing are growing exponentially. Just last week, between Hurricane Ida, our country lost 70 lives and tens of billions of dollars of economic loss. That's on the East Coast. While on the West Coast, between the fires and the droughts, we're facing unparalleled physical risks. So we're going to spend the next little bit talking about the net zero economy and the physical climate risks for banks. We have a distinguished panel today. Next slide, please. We'll introduce them more formally a little bit later, but my colleague Dan Siccardi, Senior Director from Ceres, Martha Rabner from Regents, and Amy Friend from FS Vector and former Chief Counsel, Senior Deputy Controller and Chief Counsel in the Office of the Controller of the Currency. We also have a special message from Bob Litterman. We'll join in just a few minutes. Next slide, please. So Ceres has been around for over 30 years. Many of you we've worked with and valued that relationship and continue to value that relationship. The Ceres Accelerator was started just a few years ago to focus on sustainable capital markets and how do we make them sustainable both from a climate perspective, from a human workplace perspective, as well as a financial area. To do that, we need all of us, including the banks, to decarbonize their portfolio as soon as possible. There are many banks, including many who are listening in, who have taken some big steps forward. And we really appreciate that. And you're going to hear from Regents in just a few minutes about the steps that they're doing. So all those banks, we have deep appreciation for their work. But the reality is the climate crisis is getting worse. And we need all of us, including all the banks, all the insurance companies, to do more, both setting this broad vision for 2040 and 2050, but then a science-based, client-by-client approach, how to decarbonize a portfolio to get to 2030. And society's calling on it. In fact, investors are calling on it. Just a little while ago, investors representing $43 trillion of assets under management, roughly half of the managed assets in the world, have announced their plans to get to net zero. For them to do it, the companies that they invest in, which are the same companies that the banks are loaning to, need to develop their own plans. So it is critical from a climate perspective. The investors are asking for it. Customers are clearly asking for it. And regulators are acting as well. While the US is behind, there has been a lot of activity with several federal and some state regulatory agencies, and we hope more is happening overall. Just last week, President Biden, when referring to climate, referred to this as code red. This is not a situation, next slide, please, where we are facing a problem in the future. The problem is here. It is literally with us last week, this week, next week. We still have people out from Hurricane Ida that don't have electricity back in the sweltering temperatures. And it's just going to get worse. So all of us need to work together. And because the banks play such a critical role, they're critical in that. So next slide, please. We're going to hear briefly from Bob Litterman. Bob is a member of the Ceres board, but he's very influential in many ways. Chairman of the Risk Committee of K+ Capital, had chaired the Commodity Future Trading Commission work on climate. So without further ado, let me turn to Bob Litterman for his thoughtful comments.
Well, first of all, I want to thank Ceres for giving me the opportunity to be here. I've been fortunate enough to see climate risk from many perspectives. As an academic economist, a Federal Reserve research economist, an investment bank risk manager, and as an investor and asset owner. Most recently, I chaired a climate risk committee for the CFTC looking at managing climate risk in the financial system. The impact of physical risks on the global economy, at the center of which sits the banking system, is critical from all of these perspectives. Banks, as well as financial market participants, need more data and better analytics to understand these risks, which is why we need a completely new framework for mandatory disclosure of material climate-related risks that will be useful for making financial market decisions. But we also need banks to be proactive about getting meaningful decision-useful data from their clients. Such data will be multidimensional, including location information, elevation. What's relevant will differ by industry as well as by firm. It will include potential supply chain and infrastructure vulnerabilities. It will also include data on insured and uninsured risks. The impacts of physical risk will be felt most acutely in marginalized communities, and abandoning them is not a solution to the problem. We need to build up their resilience, and that'll take more capital, not less. The analysis and recommendations of this report are what is necessary for banks to thrive and to keep businesses and investors, to help businesses and investors to understand the questions they need to be asking. Of course, in addition to the actions that banks need to take, the number one thing that all corporations need to create is business plans that are consistent with the rapid decarbonization of the entire economy, starting with a long-term commitment and shorter-term targets. The role of asset owners and investors is critical, and I very much appreciate Ceres' leadership in this work. Thank you.
Thank you, Bob. Thank you for those thoughtful comments. It's very helpful and inspirational. I'm now going to turn this over to Dan Siccardi. Dan has been with Ceres since 2016. He's a senior director in the company network, and he leads our one-on-one engagement with the financial sector. It's been influential, critical in this work. He and colleague Blair Batson have taken the lead. While there are literally dozens of people at Ceres who are involved with this, Dan and Blair were the guiding lights for that. So Dan, we'll turn over to you to give a brief update before we introduce our distinguished panel.
Great, thanks for that, Stephen. If we go to the next slide, we'll want to run through briefly some of the key findings of the study that we put out just last week. We'll walk through some of these findings and then get into the discussion that Stephen will lead. But just touching some of the highlights, the first high-level finding that's perhaps one of the most important is that of the nearly 30 banks we looked at, across them, in some of the worst case scenarios, the impacts could be $250 billion annually, or approaching 10% of their lending portfolios, even if adaptation measures are taken. Secondly, and importantly, about 2/3 of those impacts are from indirect economic impacts through supply chain impacts, reduced productivity, and these are less well understood than the direct impacts. Thirdly, as we're seeing in real time, as Stephen mentioned, coastal floodings represent the largest source of these physical impacts. Of those, we're also seeing fires are a huge area of risk and impact as well. And then finally, something that we do feel important to emphasize is that while this report is fundamentally a risk-focused report, there is also critical opportunity here for the financial sector and really the entire economy to move as quickly as it must to transform itself and adapt to the impacts of climate change, it will require a lot of capital, and the banks have a key role to play. And with that comes significant opportunity. If we go to the next slide. Just want to quickly touch on what this report is and isn't, because there are a lot of different types of reports that are out there. What this is fundamentally is a report that's highlighting what we see as 14 key recommendations, which we'll get into in a moment. And these recommendations are built on some rich and robust analysis that we've done in partnership with ClimateFin, which is a group of academic researchers that have done some cutting edge research on applying physical risk to financial balance sheets. What this report isn't, it's not a bottom-up analysis of banks' lending portfolios based on the actual asset level data. That information simply isn't publicly available. It's not a benchmark that's looking to say, you know, bank A is doing better than bank B. It's really just looking at their exposure. And for these reasons, while we do have important data here, we do want to emphasize that the information in our report should be viewed as indicative. It's not the definitive answer. And that really needs to come from the important work remaining to be done by the bank themselves. If we go to the next slide. So I want to touch on our recommendations. I'm not going to read through all of these because there's a lot of information here, but importantly, the recommendations fall into 4 categories, 2 here and 2 on the next slide. The 2 here, most importantly, is meet the moment. While, as Stephen mentioned, there is important and meaningful work already being done, the reality is there needs to be more done more quickly and at greater scale and ambition. And so our meet the moment recommendations, one is really about rising to set public, bold, ambitious 2040, 2050 goals with meaningful interim 2030 targets. And then as part of that, really disclosing impacts in the financial portfolio so that there can be greater transparency. In the assessment and measurement categories, here it's critical to assess all elements of climate risk and opportunity across asset classes and sectors, to measure the physical impacts that we're currently seeing, as well as those that we will be seeing out into the future, being able to understand those first and foremost, and then be able to apply that to financial analysis. As an extension of that, perform the important climate stress testing that can get to some of the more specific portfolio level data. And from that, get to asset level understanding of exposures that come from really understanding what specific assets, what specific pieces of properties, of company locations that might be exposed. We move next. Our other 2 sets of recommendations fall under capitalizing opportunities and taking action. On the opportunities part, as we mentioned before, and we'll mention again, this is fundamentally a risk report, but there are a lot of significant opportunities that come with preparing the economic system and really the economy and society for the impacts that will come, and really prepare us to minimize those impacts through resilience and adaptation. And so here, it's really about understanding the interplay between the banking sector and the insurance sector, and drawing on insights from insurance, focusing on how adaptation can help, if done well, can help minimize the type of risks that the sector and society can be exposed to, which we'll get into in a moment. Developing innovative solutions to adaptation finance. In some ways, this is more complex than the high risk, high reward green tech finance. And so it requires innovative ways, public-private partnerships, more longer term investments. And so developing new ways to make those attractive both to the banks themselves and their investors. And related to that, the financial sector, the private sector can't do this on their own. And so there really needs to be some collaborative work with the policy and regulatory sectors and related advocacy for that. Then on the take action, build connections and relationships with experts. Banks can do some of this analysis on their own, but partnering will be important. Integrate the insights that come from all of the work done in the assess and measurement part of this into product pricing, capital allocation, and risk measurement. and importantly, engage with clients, because at the end of the day, the banks can't make this happen on their own. This is really going to be, progress is going to be made or not made through the actions taken by all the clients that the banks do business with. And so constructive engagement will be critical. If we move to the next slide. So here, in some ways, this is self-explanatory. This is a graphic from NOAA that's looking at a range of disaster events over the last 40 years. And you can see clear trends here. And as we've seen, just in the past weeks from Ida and even today, Nicholas down in Houston, it's quite reasonable to expect that the 2021 bar graph will unfortunately be another significant one. And so these impacts are growing over time and will continue to do so if we don't take meaningful action. If we move to the next slide, this here just want to lay out a bit of the physical risk assessment framework. Going from left to right, if you think about total impacts, those can be broken out into direct impacts and indirect impacts. For the direct impacts, there's impacts on physical assets. And so that would be through all the various natural and enhanced disaster events that we saw in the previous slide. There's also impacts on labor, productivity, agricultural yields. And this indirect impacts box, while it's only one, it shouldn't be underplayed, because as we'll see in a moment, it could pose quite significant risks. So speaking of which, we move to the next slide here. This is one of the key findings from our report. This is looking at the exposure of various banks, the 28 banks we looked at, their lending portfolios. The colored bars are the different types of disaster events that we've been looking at. And the larger gray bars here, which are 2/3 of the overall impact, these are the indirect impacts, which could be quite important. Just a couple of points to make here. As I mentioned earlier, this represents up to $250 billion a year over time. And while the overall percent of the portfolio is less than what we found in our transition risk report, which we put out last year, it still will rise to a material level that requires careful evaluation and understanding. And also, it's important to note that these are potentially yearly impacts. And so while transition risk, which was a focus of our report in 2020, could be very significant, that could be concentrated over a year or several years, but not over decades. Whereas this physical risk will likely play out on an annual basis over many years and likely decades. And so these may be somewhat comparatively lower percents of the portfolio, although still quite significant, but they will be compounding year after year. So we move to do our next and last slide here. Here, just want to point out, there's a bit going on in this graph, but the important point to note is that the top green bar here is what 2080 could look like with adaptation, whereas the other colors are what could look like without adaptation. And so it's important to note that adaptation has a big role to play. It could halve or more the physical impacts if done well and done smartly. So you'll see that the 2080 line with adaptation is in some cases lower than the 2050 line without adaptation. And so here again, there are opportunities, whether it be flood protection, enhancements to the built environment, agriculture, focusing on workplace regulations, that this really can have positive impacts that can reduce impact on society as well as risks to the banks themselves. So with that, I'll stop and turn it back over to Stephen to build on the overview we just gave on the report for a bit of a discussion.
Great. Thank you, Dan. That's very helpful. A lot of rich information. I also want to highlight in the chat for anyone who hasn't seen the report, the link is there for this report. Dan also referred to the 2020 report on transition risk. We'll be sure to send that link as well. And again, you'll get a copy of this later if you want to spend more time going through the numbers. It's now, next slide, please. We're really humbled to introduce two special guests, Martha Ravner and Amy Friend. Martha is the Executive Vice President and Managing Director and Head of Financial Risk Activities for Regions Bank, with responsibility for enterprise-wide financial risk oversight for Regions' consumer, wealth, and wholesale lines of business, as well as proactive governance of credit, market, liquidity, capital, and strategic financial risks. I don't know what, Martha, I think it sounds like a one person, it sounds like you're doing lots of everything, quite an impressive set of responsibilities. Is also responsible for credit risk governance across the enterprise. Speaking of impressive people, we also have Martha Friend. Martha is a senior advisor at FS Vector and had previously been the senior deputy comptroller and chief counsel in the Office of the Comptroller of the Currency, one of the key financial regulators from 2013 to 2017. And she was responsible for all the agency's legal activities and licensing. Prior to that, she had served as managing director at Promontory Financial Group and has held very important and distinguished positions in Congress, including chief counsel for the Senate Committee on Banking, Housing, and Urban Affairs, was very instrumental during Dodd-Frank. So with that, Martha, let me turn to you first. Can you tell us what the progress Regions has made on the recommendations in the report and where the biggest challenges are for you as a regional bank in particular?
Well, first, thank you for the opportunity to participate in this discussion today. Much appreciated. Hopefully you can hear me, so nod if you can. Thank you. At Regions Bank, we absolutely believe in innovating, adapting, and anticipating the needs of the people and businesses we serve, as all are essential to our success. We are focused on enhancing our service and product delivery channels to provide better value to our clients and improve the communities in which we operate. It includes looking ahead to issues such as what we're talking about today, which is the impacts of changing climate, and determining how we can best serve as helpful advisors to our clients to navigate these physical and transition impacts now and into the future. That includes proactively assessing our own operations in a way that remain environmentally sustainable. There are many challenges, but we believe in continuous improvement, and our work around climate change and acute climate risk is a reflection of that commitment. So in looking at your recommendations, I'll touch on a couple here that where I think we're starting to see some traction. So the first one, assessing all elements of climate risk, such as physical or transition risk, and that would be under your assess and measure. One of our most recent initiatives was a client transition scenario analysis of our commercial and industrial book. That's in our wholesale portfolio. And we primarily utilize the NGFS disorderly transition scenario, and we reported the results in our inaugural TCFD, or Task Force on Climate Financial Disclosures report, which we published on June 30th. That report contains more details of the internal analysis within our own operations, and I would welcome everybody, if they'd like to see the details of that report, they can go to regions.com for that. It is important to point out that our commitment to addressing climate-related issues is already creating some progress. For example, in 2020, I can attest that our sustainable finance efforts enabled more than $575 million in renewable energy financing. That would be solar projects. Also, sustainable management of over 1 million in acres of timberland that we manage in a sustainable fashion. Our work in this space is focused on collaborating with clients across various industries and to be very constructive with them. Many of our clients are looking at ways to better assess their physical risk and how they transition to cleaner operations, or how do they adapt their industries to new requirements, new regulations, or challenges that are coming out of climate risks. We're providing experience and insights that can help our focus here with them, and includes providing financial advice and guidance to help them achieve their climate-related needs and goals. I would stress this is a journey, but one that will result in a cleaner environment and more sustainable operations all around. Another recommendation, also in the assess and measure, is projecting the future cost of climate change. And there are a couple of considerations here. One, we know the cost of doing nothing is simply too great. It is unacceptable and would be the costliest course of action, not only from a financial perspective, but also from a societal perspective. We are choosing to be proactive and as innovative as possible in this space. We know that working now with our clients and the communities in which we operate to lessen the impact of climate change will result in a more sustainable future. Collaboration, again, between all constituents, that would be us, that would be Ceres, that would be our clients, is critical. As part of the scenario analysis that we disclosed in our TCFD report, we did utilize sea level rise data from NOAA. In particular, this helped us look ahead to potential impacts on our facilities, on our vendors, on our branches, on our clients. And looking to the future, we're evaluating new technologies and modeling techniques for stress testing and scenario analysis over multiple time horizons to complement our current capabilities. We're also enhancing our in-house geospatial data and analytics and including more precise impact analysis capabilities. And it's coming in very handy with, as you heard from Dan, Hurricane Ida, as well as Tropical Storm Nicholas. We're also actively monitoring weather data to inform us of changes in weather patterns, and we're closely tracking significant storms throughout their life cycles so that we can be prepared to support our associates and our customers. All of this is helping to inform us and allows us to be proactive and be there for our clients as quickly as possible so that they receive the assistance that they need in times of acute weather events like we're experiencing now. And then one last recommendation, and that is really around understanding the changing insurance landscape. And this, I think, comes under your capitalize on opportunities. Our analysis is ongoing here, but again, collaboration is key. With regard to our own facilities, we are maintaining strong controls related to weather response. We have a very robust weather response guide, and we require periodic inspections to identify hazards and potential hazards. And this has been helpful in reducing costs and the severity of damages. We're also actively communicating with our insurance carriers regarding insurance strategy during the policy term and renewal period. And I would also add that we're building our facilities better today than in the past. Our locations are more environmentally sustainable, using more sustainable materials. They have a lower carbon footprint and are built to withstand more acute weather impacts. And this is applying not only to newer facilities, but also legacy facilities around our footprint as we retrofit, because we think that this is critical to the future for climate and sustainability. So with that, I'll turn it back to you.
Wow, boy, that's a mouthful. That is great, Martha. All the things you talked about, I think it's important, as you say, it's a journey. You have taken many, many important steps, and we appreciate those. I also want to highlight for everyone, the link to the TCFD report is in the chat, so you can take a look at that. And I hope everyone does look at it. I hope every bank does a report like that and goes through the level of detail. And we've worked with groups in banking and others that the first year's report is good, the second year report's even better as they kind of get more and more detail. So, but the steps you've taken are important. And I hope all the regional banks look at this as an opportunity. And there are already some questions, but before we get to that, I'm going to turn this to Amy with deep appreciation, Martha, for those comments. So Amy, let me bring you in and think about in your former role as a regulator in a regulatory perspective. Are there recommendations to be easy that would have been made easier by banks and regulators work together? What are the areas that maybe you can talk about in that context?
Sure. First of all, thank you, Stephen, for having me. I'm honored to be here and talking about the really important work, and kudos to Martha and Regions Bank for the proactive steps that you've taken. So Martha talked about the importance of collaboration with clients, collaboration with groups like Ceres, and there's also importance in collaborating with the regulators. So some of the recommendations that would seem to really lend themselves to working together with the regulators would be helping to develop standardized disclosures, helping to look at a framework for assessing risks to the extent it goes beyond the current risk assessment framework that we have. What is different? What's unique? How do we look out on a longer time horizon? Understanding and identifying the data that's needed to assess the risk across portfolio or at the asset level with respect to individual clients, and the projecting the future costs of climate change. I think all of those things could really benefit from the regulators and the banks working together and sharing experiences like Regions had, which other banks are also sort of on the road forward, sharing those with the regulators so that they develop a deeper understanding. I also think that there could be collaboration between regulators and industry in spotlighting examples and best practices for adaptation financing. So when I was thinking about this, there's one example of collaboration which I find particularly interesting, and it might lend itself to this area, and that is a tech sprint. The UK Financial Conduct Authority pioneered tech sprints in about 2016, 2017 to tackle what they call wicked problems. And wicked problems are problems that no one actor in the financial ecosystem can resolve on their own. They tend to be tech driven, data driven, something that clearly would be beneficial here. And the idea is you get together the government, regulators with financial institutions, tech specialists, subject matter experts, whoever has to be in the room to coordinate in a very sort of collaborative and very time limited sort of compressed space to come up with creative ideas to help jumpstart the process. So the beauty of the tech sprint is it brings together all the relevant actors. It accelerates the process. It spotlights the issue, and it fosters collaboration in a really sort of energetic, interesting way and creates networks going forward. So this might be one of those areas that would really lend itself to that kind of tech sprint. In addition to the FCA, we've seen the FDIC recently do a tech sprint, the CFPB, I believe Treasury has or is planning on one, so it's not unfamiliar to the US financial regulators.
I think the tech sprint sounds like a great idea. And being from Boston, things that have the word wicked in it, everything, it's even better. So can you just follow up on that? What can the banks do together for data collection or other information without running into legal issues of anti-competitive legal issues?
So I think working to identify the data needed and gaps is something that they can collaborate on, right, without running into competitive issues. Helping think through a framework for sort of assessing the risks that go out into the future. What's the methodology? Engaging experts jointly, advocating for policy actions. That's something that Ceres has recommended, and even making public commitments collectively to meeting certain targets. So I think all of those are collective actions that wouldn't run into competitiveness issues.
That's great. Again, like Martha, I could spend the rest of the hour just talking to you on regulatory things, but I'm going to go back to Dan and then come back to you. Dan, for banks that are starting at scratch, that don't have a Martha and the team there, and they haven't made as many steps, what are the first, second, and third steps that they should do? Is there a logical order that you recommend for banks, for you and Blair to recommend?
Yeah, it's a good question. I think that's how we structure the recommendations in the report. I think from our perspective, there are two viable routes a bank can take. One is first commit and then act, and then the other is first act and then commit. I think from our perspective, setting a bold and ambitious net zero commitment with supporting meaningful interim 2030 targets is an important first step. But we do realize that some banks and other private sector companies are focusing first on doing the analysis, getting the understanding, having the route and the strategy in place, and then setting the goal. But either way, and what we see the importance of first setting the goal is that it can help galvanize action. It can help simulate internal collaboration. It can help with the sufficient resource allocation and focus needed to then mobilize the efforts to do the analysis and set the strategy. Sometimes having that goal out there is what's needed. Once you've applied that pressure upon yourself, can help really simulate action. But either way, whether the action follows or precedes, I think what we see as important are the steps that we outlined in the assess and measure. And so first is creating the framework needed to understand the range of physical impacts, and really by extension also the transition risk impacts, because these are both equally important. But to focus on the physical risk impacts, to understand what they might be now, as we've seen and as we shared earlier, they're already upon us. But importantly, how those will grow and change over time across a range of scenarios, from hopefully what won't occur being less adaptation to hopefully what will occur and greater adaptation. And then from there, incorporate that into the business decision-making, the financial analysis, the risk analysis, capital allocation that gets to the fundamental decisions of how the sector does and will not do business with certain clients. And then ultimately, as we said earlier, because what's really critical here is ultimately the actions of the companies that the banks are working with, having a focus on deploying all of the understanding and insights that come from doing the analysis into interactions with and engagement with clients to help bring them along. Because I think our perspective is it's less about moving away from these clients, but really about digging in and helping them understand the exposure that they themselves face, and through that, how they can transform their businesses and their sectors in ways that banks can not only continue to do business with them, but do even more business with them to enable their individual and by extension, collective and really societal transformation that we need.
Let me just ask a quick follow-up on that in terms of digging into clients, as you said. You talked about in the report, the need for that. If banks haven't been doing that, clearly Regions has started that process in terms of talking to clients. How do they do that? Because eventually that's a difficult conversation. Say a client, we have to change your decarbonization plan, use of GHG emission. How do you recommend, or what have you seen successful with some other banks?
Yeah, it's a good and challenging question. I think what we see is, as is the case with a lot of this, it can be done in stages. It's probably not realistic for the first conversation to be, you need to completely transform your business, but it can start by incorporating into the already, conventional due diligence process some of these questions about climate risk. What are their emissions? Where are their facilities located in perhaps geographically vulnerable regions? Getting that understanding from the client, as well as helping the client develop that understanding for themselves, if they haven't already, is an important first step. And then I think what we would see from there is the second order questions about, how are you thinking about adapting your business, both from a physical risk perspective, from a resilience and adaptation perspective, but also from a transition risk and business transformation perspective. And just building on the point that was raised earlier with Amy about how could the sector work together. We do know that the banks are asking similar type questions, particularly as more and more are starting to focus on this topic. And so finding some common ground without getting into competitive issues, where you might be able to ask some common fundamental questions that are important to all the banks. That could help create greater consistency and reliability, and hopefully also ease the burden on the company so that they're not asking slightly different version of the same types of questions 15 different times.
Absolutely, that makes sense. And I'll just say that for the folks who are listening, whether it be banks or regulators, if we're working with many of you now, but if we're not, and if there are ways we can be a resource sharing information, please let us know offline. We want to be helpful. Let me go back to Martha, a specific question, but also if there's something that Dan said or Amy said, feel free to add to that as well. Many of the clients that are going to be worst hit by natural disasters are individuals and small businesses in low and moderate income communities. What are the steps that you're taking to assure that they don't suffer the extra burden, and that in fact we try to ameliorate some of the systemic racism that still exists in our society?
Great question. I do think it's critical for regional banks such as Regions to proactively reach out to their clients as well as to the communities in which they reside to understand the needs and design appropriate solutions. Our intent is always to provide value and solutions to all of our clients, regardless of where they're located. So, as I mentioned earlier, we actively use that geospatial technology to identify potential areas of need during an acute weather event like we saw with Ida last week and we're seeing now with Nicholas. And we have designed and have long-standing customer assistant programs to support our clients and communities in their time of need. So, with our geospatial technology, we can see real time where a storm is tracking, for example, as with Ida, and be ready to proactively deliver assistance as that need arises. And that has taken the examples of, in the past with Katrina, certainly now with Ida, of having mobile ATMs to get them out to those clients so that they are not adversely impacted as they're dealing with everything else from a climate risk perspective.
That's so important, and the geotechnology work you're doing is we're getting a lot more information. So that's fantastic that you're using that. I do want to. We have several questions already. Some we've already grappled with, and some we hope to get to. Encourage you, if you haven't submitted a question, please feel free. Amy, let me ask you also the question about how can regulators, how are they today, or what are the ideas they might think about to consider the needs of marginalized communities, particularly in regions when thinking about climate regulations, whether it be Community Reinvestment Act or mortgages or other areas that you think might be relevant?
So good point, which is that the regulators need to think about opportunities here and not just risks. And obviously, as the banks are mitigating the risks that they have to do it in a way that's not illegally discriminatory and in a way that truly serves all of their customers. So the CRA is one way that the banks can, or the regulators actually can signal that this is an area where a bank would get credit for coming up with either innovative financing, for innovative projects and infrastructure or other ways to help low and moderate income communities. The CRA right now is being looked at by the 3 different banking regulators. They've indicated that they intend to come out with a joint regulation. So it's a good opportunity to weigh in on something like climate change. So that's one. The other is to encourage some pilot programs and so that others in the industry can learn from that in terms of adaptation finance. And finally, obviously, like regions, if you come up with, where you come up with good solutions in different regions that are affected by different events from climate change, it gives the bank a competitive advantage.
That's great. That's very, very helpful. Martha, one of the questions that came in was a question for you. Have you experienced any resistance among your customers, particularly commercial industrial customers, as you're looking at their business model and having these challenging conversations, how do you reach them and how do you kind of move them?
Excellent question. And I think, every client is at a different stage in their climate journey. I think across the board, everyone recognizes that there is climate impacts and they're accelerating, and that there is going to be more acute risks and impacts coming in the future, as well as transition risk. And businesses are recognizing that, and they may be at different stages in that journey, but I think at the core, they all recognize that it's here and they have to take action. And so, from our perspective, Regions, we are there to listen, to provide advice, to really think through all of the advice that we're getting from our clients, and then try to innovate and come up with solutions that are going to be positively impactful. Again, I think I said it earlier, it's going to be a journey. It's not going to be a straight line. There'll probably be fits and starts, but we have to continue the conversations. And there's a lot of smart people out there, whether it's clients, whether it's consumers, businesses, associations such as yourself, our regulatory partners. All of them have great ideas. We have to harness all of it, bring it together, and come up with solutions that make sense. And those solutions will change over time.
Yep. Yeah, no, and as you say, there are a lot of, it's good to hear that a lot of customers understand the issues and they're working on it as well. It is very much of a partnership.
Well, I'm sorry,
No, go ahead.
There's a financial impact, and they're seeing that, and they see it near term, they see it long term, and they understand that the actions that they take today, as I said earlier, doing nothing is unacceptable. The consequences are costly, too costly, and I think across the board, people are seeing that and recognizing that they take action.
I don't do tattoos, but if I did, I would use that quote, doing nothing is too costly, because it is a mantra. You're exactly right. Dan, speaking of costs, in the report talks about the biggest single risk is the indirect supply chain and that the companies would face. How should banks think about that risk, and how is it different from the first order hazards that they face?
Yeah, it's a good question because, as you mentioned, it's a challenging situation where the largest risk is also the least well understood. As we mentioned in some of those earlier slides, the indirect risk may be as much as 2/3 of the full picture here. And so I think in this instance, banks need to work with their customers to enable their customers to do a similar exercise that the banks themselves are doing. Namely, that it's not enough for the banks to understand their customers' own direct exposure, because that gets to that first order question. But the customers themselves need to then understand their own exposure in their supply chains. And that's where you get to this second order risk. And so there's probably a collaboration here that can be done where customers can learn from the valuable, important work that the banks are doing to understand the customer's own direct exposure, to then help those customers understand their supply chain risk, which will create a fuller picture for the banks for their direct exposure and this harder to understand indirect exposure. So it'll probably take some collaboration and might be a second step in the process where banks may start by understanding the direct exposure for their immediate clients and then work together to understand that second order exposure and the risks and opportunities that go along with it.
I think that's so important. Amy, from a regulator perspective, how do they think about the second order? We all faced at the beginning of a pandemic shortages and everything. People talk about toilet paper, but in lots of other things as well, because of some of the first or second order. How do regulators think about this as they think about risk?
Well, they're clearly beginning to grapple with the complexities of how you can reliably measure these types of risks. So I think it's on the radar screen, but it's another huge wrinkle, obviously, in what they have to assess, and likely goes beyond the sort of normal type of risk assessment that banks are engaging in. And so I think it's going to take some digging in, talking more to experts. I know I was listening to a podcast yesterday with Acting Controller Sue, who talked about the various effects and even talked about originally having been a skeptic about the effects of climate change on the safety and soundness of institutions. But with more digging in and research and talking to experts, he's now convinced, but is grappling with how do you accurately and reliably measure these different risks that you then call upon the banks to account for. I think that's what they're dealing with.
Absolutely. That's fascinating. And his evolution, as you indicated, is an interesting data point. A question for any of you. You talked about the importance of getting involved and also advocating with policymakers. What can banks better do when the trade associations they belong to maybe advocating on the opposite side? Right now, we're debating lots of important issues in Congress, and some of the trade associations, not just banking ones, but general business associations, are recommending against change in some of these areas. Ceres has a separate report called Responsible Policy Engagement. How should banks address that when the trade associations are taking positions that may be different from their own? Question for any of you.
I'm happy to jump in, although I would be curious to hear Martha's perspective. I mean, I think we would recommend to borrow what she was saying earlier, that that the cost of doing nothing is far greater than the cost of doing what needs to be done. And so making the business case that, yes, this all comes with price tags, but you have to put it in the broader perspective of, the cost will be far greater and will be borne by society in far more significant ways if we don't act in a proactive and strategic way.
To add to your question, the way I think about it, certainly we actively listen, and we are reaching out and seeking insights and advice from a variety of constituents, our own clients, be it consumers or businesses, associations such as yourself, regulatory bodies, and there will be differing opinions and recommendations out there. And I think it's on us to take that all in and then synthesize it and ensure that we have appropriate framework around it, and then just objectives that we have set in place that we want to adhere to and execute on. And from a region's perspective, we are in agreement, and certainly on this topic, that there is climate impacts, that they are continuing to accelerate, and that it is appropriate for us to start on that journey to take the appropriate actions to ensure that our clients can be successful now and into the future, and for us to be successful now and into the future. But that requires listening to all parties and hearing all sides of the argument.
I would just add that there needs to be more information that gets out to inform policymaking in general, and that is something that banks and trade groups can advocate for, which is let's really understand what's out there, and and let's have an informed discussion. I know it doesn't always work that way, and I understand that the politics here can be a little fraught, but it seems to me that the better the information and the more that gets out there, there's going to be a better understanding that, as you say, the cost of doing nothing are much bigger than the cost of actually trying to manage right now, because otherwise it's too late.
Excellent points. Yeah, again, each one of these, I think there's so many follow-up I'd love to get to, but I want to try to get to as many of the questions that we received. There were a few questions that we received. How will increased climate disclosure by clients, either by the SEC or others, impact your work? And I'll give my first perspective, Kate, moderator's prerogative to give but then welcome any of you as well. That as our audience knows, the SEC is seriously looking at coming up with a proposed rule at the end of this year for comment on mandatory climate corporate disclosure. That if there is in blank months a rule in place, that I think it would be a real benefit for the banks. But love to hear Martha's perspective, because then each of their companies' data will be out there, that we're using a consistent method. Right now, there are many forms of climate disclosure, voluntary, but they're inconsistent. So there could be 5 companies in a steel industry or in the restaurant or in the agriculture, whatever it is, that it's hard for a bank to compare apples to apples. So this way, it would at least be a baseline. It doesn't change those difficult conversations, but fundamentally in any business, you can't manage what you can't measure. And at least this would allow us that baseline. But I don't know, I'd welcome anyone to either elaborate or feel free to disagree.
Well, you hit the nail on the head. You can't manage what you can't measure. And certainly at our institution, that is one of the guiding precepts of sound risk management, is being able to measure the risk in your portfolios. And to your point, there is not commonality. And certainly we welcome those actions that will provide better insights and more of a apples to apples comparison, because as it stands right now, to your point, we don't have that type of comparison, and we're having to make risk assessments that are using good data, but differing data. So, I'm welcoming anything that would lead to better insights and understanding by all. Common taxonomy.
Great. So Martha, let me ask you the final question and like 30 seconds. What is the biggest opportunity or challenges in integrating geospatial analysis in your business processes? What are the upsides and what are the challenges? Again, just at a high level. You're on mute. You're on mute.
Sorry about that. I really like our geospatial capabilities, and I'm continually looking at how can we enhance those. And so it's really looking out at all of the data sources out there. How do we bring it in and incorporate it into our platform so it provides meaningful information and helps us direct our attentions appropriately on our clients and the portfolios that are being impacted. So, I can go at length as to all the different data streams that we get today, but being a data nerd, I want more, so.
That's great. That's fantastic. So listen, the only unfortunate thing is we've run out of time. We clearly could spend another hour or two with this distinguished panel. But I want to thank both Bob Litterman for joining us, Amy and Martha. Really, you've added a lot of insight to this. Dan and Blair and the entire Ceres team that worked on this report. And I encourage all of you that are joining us to, again, many of you we're working with, and we value that. Those who are not, let us know. We want to be a resource. We want to answer your questions. But the only way we as a nation and we as a world are going to solve this enormous, complicated problem that, as I said earlier, President Biden called red alert just the other day, is by working together. So thanks for those of you that are taking the steps, and we have a lot of more work to do. So thank you again to the panel and all of you, and have a great afternoon. Thanks.
Thank
Bye-bye.
you.
Thank you.
Thank you.